Hello and welcome to our webinar. My name is TJ. I'm head of the investment specialist at Hargreaves Lansdown. Today, we're going to be talking about how a fund manager picks stocks. And I'm really pleased to be joined by my good friend and colleague, Steve Clayton, who's head of the equity funds at HL and also the founder of the HL Select range.
Hi, TJ. Good to be here.
Thank you, Steve. Now, Steve, this is a very interesting time to be looking at the investment markets. It's a high interest rate environment, for example, and that provides temptation for many investors to put their hard-earned cash away into a savings account. And whilst I appreciate that there is absolutely a role to be played here, especially in the short term, when you need access to that money, what would you say, and what would be your elevator pitch to our viewers today on why investing should be considered to help them achieve their financial goals?
Oh, you're absolutely right. There are higher returns available on cash now than for some time. But it's also true that over the long term, markets tend to perform better than cash and other savings. And talking really about periods of 5 years or more, but as somebody who's picking stocks in the stock market, over those longer time periods, I would confidently expect to be able to perform better than cash over the long run. But stock picking is not the same as just investing in the market. It brings additional risks, and it's very important to pick the right stocks. If we look back, for instance, to the turn of the century, you could have invested in still a relatively new online business called Amazon. And yes, you would have been investing right at the top of the tech boom, but 10 years later, you would have actually turned $1,000, say, into almost 1,800. But this is where the stock picking comes in. If you pick the wrong name to back, the outcome could have been very different. Back Ford Motor, for instance, at the same time, 10 years later, your $1,000 would have turned into slightly less than 350. So massive difference in the outcome. So it really matters, if you're going to go down the stock picking route, it really matters that you know exactly how to navigate around that territory, which is why we're here today, I guess.
Excellent. Exactly that point, Steve. We wanted to host this webinar for our viewers so they could hear from someone who enjoys stock picking. They could hear from someone who thrives on stock picking and has to do this in their everyday job. And with someone like yourself who's been quite successful, I think that's some great insight for our viewers. So let's take a look at your background. However, let's dive a little bit into your history, put you on the spot. What is your background as fund manager, Steve?
Sure. Okay, so I left Cambridge University a very long time ago with an economics degree. And what that degree taught me was just how much the way that economies and markets can interact and generate wealth, which has it's always been a fascinating subject. And going into the stock market was a great way to develop that. I've worked for a number of investment houses in roles from analyst to fund manager to stockbroker. My last role before I came over to Hargreaves Lansdown in 2014, but I was a partner of a firm called Mirabaud Securities, advising other fund managers on stock selection and strategy and stuff. I came to HL because we saw an opportunity to set up a fund range which would give something a little bit different to investors. We launched our first fund, our first HL Select fund, in 2016, and it's a differentiated approach. We believe in giving investors transparency, letting them see what stocks they're holding, not just the top 10, and giving people the chance to see rationales, why we've invested in one stock over another. And we show pretty much the whole portfolio in close to real time. We're now running 3 funds. They're all concentrated equity strategies. Between them, there's about £1 billion of Hargreaves Lansdown's clients' money. We've got a couple of growth funds, one focusing on UK companies mainly, the other investing globally. And we've got an income fund which takes advantage of the above average dividend yields available in the UK market to try and create a portfolio that will offer an attractive income as part of the total return to clients. We are what we call concentrated in the way we operate. We only hold about 25 to 50 stocks in any portfolio. That means each position can make more of a difference to the investor's outcome. It's a higher risk strategy than, say, owning a very, very large number of companies. And it means that we have to be very selective, because we're holding a few dozen out of potentially thousands of names around the world that we can be choosing from. So we are very selective.
Thank you, Steve. Before we go on, though, we do have a little bit of housekeeping to cover off. In total, we have about an hour here today, and we expect this presentation to last 35 to 40 minutes. And that's going to leave 15 or 20 minutes reserved for Q&A. You can email questions that you have for Steve by emailing us at webinarq&a@hl.co.uk. That email is on your screens now. And those of you who have a professional Teams account can use the Q&A function on Teams to raise your questions. We'll see those questions coming in, and we'll do our best to answer as many of them as we can at the end of the session. If you're emailing us your questions from your phone, you should be able to do this without leaving the webinar. So as long as you do not swipe away or cancel the webinar screen. And finally, this session is being recorded, but please be assured that we can neither see or hear you, and your names are not visible. A video from this session will be circulated by email later on. I do need to stress, though, that everything discussed is purely informative and not financial advice. And given the time constraints, it's not exhaustive. But I hope what we discuss here today will give you a deeper understanding of what a fund manager considers when investing. So now let's take a look at the agenda. We're going to be taking you through Steve's process for picking stocks and hopefully drawing out some practical actions that you could apply to your own investment choices. And this includes establishing an investment objective, defining an investment universe, and the ideal fundamentals that Steve and the HL Select team are looking for in potential investment opportunities. We're going to cover what Steve is looking for when he goes through company reports, as well as the less tangible factors that you should consider that help you understand the potential success of a company. And at this point, we'll take a step back and take a broader view of the current economic environment, vital in your consideration of a potential investment. We'll find out from Steve what he thinks of the big industry trends, and we'll be defining investment options in the months, for years and years to come. Finally, we're going to look at some metrics that Steve and his team are monitoring on a continual basis once they're invested or have an eye on a particular stock. So let's start from the beginning, Steve. How does a fund manager kickstart the process for picking stocks?
Okay, so we're running portfolios, and the key thing that we have to do is we have to start out by setting out what is the objective. What is the fund going to try and achieve over time? And then we go on to talk about our investment policy, which is basically the broad brush rules about how we're going to go about achieving this objective. And so we're basically saying what we're trying to do, how we're going to try and do it. And this is something that actually any investor can do, because it's a good way of trying to sort of rationalize what you're doing and sort of set out your motivations and your plans, because you can refer back to that along the line to see whether you are sort of sticking to what you said you were originally going to do. It's really important to think about the time frame under which you're going to be investing, and also how much risk you're prepared to take, and always be realistic and keep going back to doing that, because this is what a fund manager does. They look at their portfolio, how it's performing, and they say to themselves, am I still on track to hit my objective? Am I sticking to my policy, investing in the way that I said that I would do?
Thanks, Steve. You mentioned risk over there, and this is a very important element that investors need to understand and need to manage. So what do you mean by investors spreading the risk?
It's what we call diversification. You can't afford to have too much of your outcome depending on one particular company or one particular event. You need to spread those risks as much as you can while still remaining on course to potentially hit your objectives. It's really important to set rules for yourself to manage that riskiness, because you need to start thinking about things like, how much am I prepared to lose on any one investment? Because the future is uncertain. Things don't always plan out the way you expected them to. It's important to try and be as unbiased and objective as you can be when thinking about investments. It's dangerous to fall in love with a stock because you don't know where it's going to go in the future. You have your best case view, but nothing is guaranteed in the investing world. There are many ways of diversifying. You can diversify across asset classes, so equities and bonds and other things. You can diversify across industries and geographies. Maybe don't have all your money in one country, for instance. In HL Select, we tend to have 25 to 50 holdings because that allows us to spread it across a number of different industries and types of companies. On its own, it's maybe not a completely diversified portfolio, but we are always trying to spread that risk.
Thanks, Steve. And another point you mentioned earlier when setting your objectives is the time frame for being in the markets. But what about timing?
Okay, I mean, everyone needs to know why they're investing and when they want to achieve their outcomes for. But most important of all, really, is time in the market rather than the timing of individual buys and sells. There's a lot of evidence over time that says that the most single important driver of returns is how long you are in the market, not your success in picking when to go in and when to come out. And it's worth remembering that the returns that you're going to make are always uncertain, but the costs of trading are guaranteed. So if you chop and change things too much, you can actually end up eating into your returns simply because of the cost of transacting. It's much better to make well-considered investments and then stick to them. And I just think the stock market it is absolutely no place for short-term investment because by its nature, you are incurring more of those transaction costs. It's much more suitable as a place for long-term investment. And typically we would talk about 5 years plus as being the minimum. And obviously people who are starting out planning their pensions are often looking at decades.
That's true. That's true. Steve, on the points we've spoken about so far, we've talked about setting your investment objectives. We've talked about understanding your time frame. We've talked about understanding risk. But when I look at the investment markets, when I look at the stock markets in particular, it is a dauntingly large number of stocks out there. There are over 10,000 listed stocks for you to choose. In your portfolios, for example, you mentioned you've got 25 to 50 that you would typically be looking to invest in. So what would you say to our viewers in actually filtering down from that 10,000 list? How do you pick your select few?
Okay, it's a bit like being a football manager. There are an awful lot of people out there who can kick a ball. But what the football manager's got to do is sort of filter down from the number of people who can play football down to the much smaller number of people who can play football very well. That, if you like, is the squad. And each member of the squad has got particular characteristics that make them suited to be in there. But then for the final team, the manager is going to choose the players who he thinks are going to have the best attributes for the match that they're going to be playing next. And that's sort of what the fund manager is doing. He or she is taking that huge universe, far too big a universe to know everything about everything. And they're trying to filter it down to a smaller number of companies, which are a more manageable list to work with, by setting criteria that they can use to sort of weed out and get down to a more manageable number of names.
Okay, so then how do you actually drill down from this research watch list that you've mentioned to actually get closer to your final portfolio?
Okay, so we're going to filter to get to a watch list. You're going to filter out all the companies that have undesirable characteristics. Maybe they're in the wrong part of the world. Maybe they're in an industry which you think is is going to struggle longer term because maybe technology has made it become outmoded. And you're going to try and filter down to a smaller list of companies, still big enough to be expert on each member of the list. And those are the names that you're going to choose from for your portfolio. And the idea is that you should use the filtering process to end up with a list of the most eligible candidates to go into a fund. But there's still plenty of more work to be done, even after the filtering, because we haven't yet actually gone down and looked at the specifics of an individual company.
Okay. And I assume that as part of your filtering process, there's going to be criteria that you'd be looking for here. You mentioned that a few minutes ago in your previous response. What exactly would this criteria look like?
Okay, well, I suppose the first things first is the sort of investors that we are. My team and I, we are what I would call fundamental investors. We're very much focused on what the companies do, how they are managed, what is driving their growth, what is driving the industry in which they're operating. You know, what's actually going to give them the ability to grow over time, because that's what we're trying to establish. And we don't look at technical factors, we don't look at charts, we're just really, really focused on how does this business work? And we want to be absolutely sure that we understand what it is, what makes it better than its competitors before you can go into looking at its financials. What we're trying to do is build a case as to why a company is going to be commercially successful, even in what are often very, very competitive environments. We're looking for the needles in a haystack, remember, because we're concentrating down from thousands to just a few dozen. But it's really important to us to try and find great businesses that are capable of long-term success. And I think there's a sort of a profile for what we're looking for. I see that there's a virtuous circle that the ideal company can create, and it all starts with businesses having really fantastic products and services, things that stand out from their competition, things that their customers will actually pay up for, because we want to invest in businesses that are price setters rather than price takers. Because if you've got that degree of pricing power that allows you to set your own price, then you should be able to earn a better profit margin than your rivals. And if you do that, you've got more chances of earning strong cash flows. And cash is absolutely vital to any business, not least because it allows you to operate without being dependent on the banks. And that really matters if the economy goes into one of its periodic recessions. And if you've got that cash flow and that financial independence, then the next thing is you can afford to keep reinvesting into making those products and services best in class. And that circle turns over again and again and drives growth over the long term. And everything that we do in our research is designed to identify to what extent any business fits into this sort of profile.
Okay, so then with these criteria that you mentioned as your preference as a fundamental investor, would this be how you build a stock profile?
We do. We always put any company that we're looking at through one or more templates, and it's all about identifying the profile of the company. How repeatable are the drivers? How wide is the competitive moat? What is actually going to make this business merit one of those very small number of places in our portfolios?
Okay. And then I guess once you've actually made a decision on what you're going to invest in, you've made a decision based on these criteria. What happens next? Is this a one-time done deal, or do you have to revisit?
I wish it was. Then we could all go to the beach. But no, we live in a changing world. No 2 weeks, months, even days are the same, and businesses have to adapt. So we have to constantly monitor what is happening in the industries and the sort of ecosystems that are invested companies actually operate in. It's a constant process, trying to make sure that the reasons that we invested in the first place still hold true as strongly today as they did at the time that we first committed to a company.
All right, thank you, Steve. That's great. I'm going to pick again on the words you've used over here. You said you need to constantly monitor. And I guess a great source of information for any investor may be company reports and accounts, but this is a pretty big report that you can see with many firms, sometimes hundreds of pages long. What exactly are you looking for in these financial statements and reports that are being published?
There's a lot of stuff in there for investors. They can be daunting, you're absolutely right. I mean, some of them are massive documents. But there's a few things that I would highlight. First of all, every business that you invest in has to have financial metrics that make sense. There are literally hundreds. I'm not going to force you all to go through them, but there's just a few numbers which I think all investors should check before they invest into any business. First one is a ratio called net debt to EBITDA. I think the formula should be on the screens at the moment. And this is just basically a way of looking at the financial strength of the business. How much do they owe to their creditors versus how much cash flow is coming into the business? It's a metric that only really works for industrial and commercial companies, not things like banks and insurers. And ideally, I like to see a company that's actually got no debts, a company that's got cash in the bank. But if the business is reasonably predictable, a degree of borrowing or leverage can be appropriate. The key is that number should be a low number. I would never really feel comfortable in a company having debts that are more than 3 times their EBITDA. You have to be a very, very predictable business indeed to be comfortable running with a larger number than that. Another metric that I would urge investors to look at, and this is particularly relevant for investors who are hoping to generate income from their portfolios, and that's the dividend coverage. I mean, a lot of you will already know this, but it's always worth just checking how well covered the dividend is, particularly by cash. At its most basic, just look at the adjusted earnings per share relative to the dividend that is being paid out of those earnings. If the earnings per share are less than the dividend, then the company isn't even earning enough money to pay that dividend, which makes its sustainability look rather in doubt. And remember, all dividends are variable. They're not guaranteed. Everything depends on how strongly the company is performing and expects to perform going forwards. So look for a number that's comfortably above 1, maybe 1.6, 2 times, ideally 3, and that suggests that the dividend is more likely, but not guaranteed, to be sustainable going forwards. And the last metric that I'd like to talk about is my favourite metric of them all, which is the operating margin. This is simply how much money per pound of sales or revenue the company is turning into profits before paying off any creditors. And I see operating margins as being sort of a vote of confidence by customers in the quality of what the company does. And I always like to look at the operating margin of a business relative to that of its competitors. If it's earning more, then the chances are it's doing something right. And if it's earning less, then maybe there's a problem that we need to look further into. So I always try to find a portfolio that's got lots of companies with very healthy operating margins.
Thank you, Steve. But the number doesn't quite tell you everything, does it?
It certainly doesn't. I mean, remember, everything is driven by the drivers, of course. The drivers are what really matters. Why is this company able to grow? And often it's about things that aren't that tangible. It might be brands. Is a company's brand stronger than its rivals? Has it got an awful lot of intellectual property? And it's it's really important to understand what else is behind those numbers. And that means just trying to block out the noise and see what has this company got that is going to be a growth driver going forwards. And also the other thing, when if we go back to those data from the annual report and accounts, it's also important to remember that it's publicly available. It may already be priced in. So it's not enough just to look at where the company has been, what it's reported. It's all about thinking about where it might go next to work out whether there is an investment rather than just a good company.
All right, thanks, Steve. You mentioned as well about tangibles and intangibles over here. So what would you say are, or if you wouldn't mind diving into some of these intangible points that are important?
I mean, think that intellectual property is often an absolutely key driver of a company's growth. If you take a software business, for instance, it's invested lots and lots of money in creating that software, and it is the only party that is actually allowed to sell that software. It has intellectual property which guarantees it, and so that gives it a protected position. Unless somebody has come up with something better, it has that territory to itself. The other thing that always need to remember is, are the management doing a good job of positioning the company for the future rather than just managing where the company used to be in the past? A great example there is Blockbuster. They were great at running video stores, but they were unable to see or unable to make the company move to being Netflix, which is where the future was. And unless your management are capable of taking the company forwards, then your investment is going to run into trouble somewhere down the line. It's really important to know that governance is being done properly. There's a lot of stuff in annual reports about this. It can be very dry reading, but it's important to know that your board is providing proper oversight, that they are paying their executives the right amount for the job that they're doing, that they are holding directors to account and making sure that people are turning up for all the different planning meetings that they should be. I say it can be very, very dry, but it's vital stuff. And the other thing is, in the annual report, there are sections on risks. The company's directors have to explain to their investors what they see as being the key risk factors affecting that business. Read that, make sure that you think that they have got a proper grasp on the challenges that the business is facing. One of the advantages that fund management teams like HL Select have is that we are able to speak directly to managers and to put our questions to them face to face. It's a huge advantage. For private investors, it's always possible to go to the company's website, find their investor relations contact, and if you've got questions, ask them of those. If you really want to speak to the management themselves, go along to the AGM. Put your questions to the companies. They have to talk to you.
Thank you, Steve. That's amazing, and that's a good amount of information here. I think it's also important for our viewers to understand that none of this is happening in a vacuum. You said earlier that no 2 days are the same, no 2 weeks are the same, no 2 months are the same. So in this particular case, let's take a look at the broader picture and economic situations. What would you say are the wider trends, for example, that are developing that your team in particular may be keeping an eye on?
Okay, we've been through a pretty extraordinary few years, what with pandemics and now conflicts erupting. And that has clouded the outlook. One thing does seem pretty clear. Economic growth rates are likely to be lower than has historically been normal. Only a few days ago, we had the IMF coming out, and their view of where growth is headed is positive, but significantly below the longer term averages. It's coming in a bit stronger on the far side of the Atlantic, not so strong here in the UK and Europe, but still in positive territory. But basically, growth is going to have to be hard fought to win, because we are in a relatively sluggish economic environment. We've obviously had a massive inflationary surge, the likes of which hadn't been seen for decades. That looks to be ebbing away, but of course, nothing is ever straightforward. We're seeing rising transportation costs re-entering the puzzle as a result of what's going on over in the Gulf. Central banks are still at that stage where they're not totally sure as to when they can go about reducing interest rates, but it does look as though we are headed towards lower rates as 2024 progresses. Maybe not quite as many cuts, though, as some investors have been getting excited about. Things look pretty exuberant from that perspective. We're going to have a lot of news this year, because more people are voting in elections than I think for any year in decades. We've obviously got a general election expected here, most likely in the autumn, but it could be in the spring. Very unlikely, I think, that it goes into next year. No one wants to call an election around Christmas time. In the States, we're going to have a new president. Looks like it'll be an old president in both senses. But an awful lot of other nations also going to the polls. So lots of talk of politics, I'm afraid, which is normally a distraction. Not many people change the number of cornflakes they buy because of who's in power. So remember, politics is often overstated in its importance. We've got, rates might be about to fall, but a lot of companies are still going to see their interest costs going up, because borrowings that they took out when rates were absolutely at rock bottom are now maturing, and they're having to be replaced at higher levels. So there's going to be a rising cost of debt, creating a headwind for company earnings in the next year or so. And of course, then there are the mega trends, if you like. We've got artificial intelligence. The market is absolutely captivated by this. Clearly, there is the potential for enormous change, enormous incremental automation and intelligent automation of processes and manufacturing. Companies that get it right have got the opportunity to steal a march over their competitors. A lot of what my team are focusing on at the moment is trying to identify who's best placed to win as this new emerging technology is applied. Some businesses are benefiting directly because they make the chips, for instance, that is actually being used to run the stuff. But it's going to be impacting in such a wide range of applications. And the other thing, of course, is we are going through an energy transition on the path to net zero. It's going to be very expensive as we rebuild grids, we change from fossil fired to renewable generation or nuclear. All that money is one person's cost and another person's opportunity. The companies that are well placed to actually provide the path to transition have got big opportunities in front of them. So there is a lot going on right now. Some of it is downbeat, some of it is big potential, and that's the joy of being invested in the stock market. You get to look at what's changing in the world and try and put your money where your mouth is.
There is a lot going on, Steve, but there is one thing that's been bothering people for a significant period of time right now. So I'd like it if we could just dwell a little bit more on inflation. How does a high inflationary environment affect stock pick?
It does matter, and where the thing that's at the heart of it is that if investors are going to be operating in an inflationary world, then they need to make sure that the companies that they're backing have got pricing power. Now, inflation doesn't affect all companies and industries alike. Everyone's got their own set of exposures. What's important is that companies that you invest in have the ability to control their input costs. That means having the sort of relationships with suppliers that allow them to manage those input costs. In an environment like this, it's unlikely that anyone is going to be able to completely offset the cost pressures. So the next thing is, do they have a strong enough commercial proposition to be able to pass those prices on to their own customers? That's what pricing power is all about. And if a company has got it, then it can protect its competitive moat, it can protect its margins and its selling price, and it can control its selling prices. As I say, the impacts vary depending on where you're looking at. For instance, hospitality. We're seeing big percentage increases in things like the national living wage. That's a direct cost for a hospitality operator. Hopefully, their customers are getting some of these wage increases through and it'll all wash out. But it's a particular challenge there. Whereas if you've got a company that's got a much lower dependence on labour, then they may be less worried about minimum wage, but more concerned about how willing their customers will be to absorb any price rises that they need to pass through. So it comes back down to, has your portfolio got companies that are strong with pricing power?
Thanks, Steve. Then would there be any key takeaways that we can have here for our viewers?
I think the most important thing is always to try and take a holistic view. Don't just immediately act on something that you've read about in the paper. Take the time to get to understand what a company is doing. Where are the growth opportunities that it can capitalise on? Are they durable? Is it going to be able to consistently grow? Because that's how most wealth is created in the stock market. It's through businesses that generate consistent growth in their profits, which they can then pass back to their shareholders. It's really, really important. And also, if you're trying to manage a portfolio over the long term, think about trying to have that research watch list as well. The companies that maybe you're not holding today, but which might come in handy somewhere down the line if the economy takes a slightly different direction.
Thank you, Steve. These are all some really fantastic points to consider, and we are moving to the final section of this webinar. Before we give our viewers the opportunity to ask these questions, I thought that perhaps we could talk a little bit more about monitoring. So in this case, you've listed your objectives. You know exactly what you're trying to understand here. You understand risk a little bit more. You've built your stock profiles, but how are you going to be tracking this stock? What triggers would you be looking for before you make any significant moves?
Okay. Yeah, I mean, we divide our time up between monitoring what we already own and looking for new ideas. And I think the majority of time is spent on the monitoring. And we're looking at a lot of things. We're checking in on companies every time they report earnings, making sure that the numbers are where we thought they were going to be, and trying to get a feel for how the numbers are changing moving forwards. Because remember, the stock market is all about discounting the future, and understanding where change is happening is key to success. We're looking for what sort of, what's happening to the sentiment of their customers. Are customers looking to spend more or less in any given industry? So that's impactful. Looking at individual companies, well, it's not enough. You've got to look at their competitors and their industry. So we're spending a lot of time tracking industry developments, as well as what's happening in an individual company's operations. We are monitoring those financial ratios. Luckily, we have access to systems like Bloomberg, which will provide us with an awful lot of information at a glance. It can be harder to do that outside of a professional fund management team. We're also thinking about the time horizons that we need to think of for the companies here. When do we expect it to make the next step forward? Is the market in tune with that timetable? Is the market getting carried away? We want to speak to companies as often as we can. It's really useful to be able to get their views as to how their world is changing, and that's what we're most interested in: change, understanding how that's going to drive the value of the businesses that we're holding. And lastly, obviously, we're looking at the economic cycle. What is happening in the major economies? Where do we think the world is going economy-wise?
Right. Thank you, Steve. And that actually brings our session to a close. We've got some interesting questions coming through, but do keep submitting your questions for the Q&A. Remember the website, it's on your screens. It's webinar Q&A at hl.co.uk. Steve and I will be looking to help answer these questions in a minute or two's time, so please keep sending them through. If you are interested in finding out more about Steve or the HL Select funds, we have a QR code on your screens now. You can scan that code. It'll take you to the HL Select funds webpage. And now a final slide for your consideration with some important investment notes. Please do take a few moments to read through them. They reiterate that this session was purely informational and not to be construed as financial advice. Stock markets can fall as well as rise in value, so there's always a risk that you could lose, or get back less than what you put in. Just take a moment for that before we move on to answering these questions. Right, I think that's good for us. So without further ado, Steve, let's get through a couple of questions we've got here from our viewers. Remember, if you haven't already, email us at webinarqa@hl.co.uk. We'll do our best to get through as many as possible. Thank you so much for being so engaged. We've already got some great questions here. And I think from our selection, let's actually start with what factors should determine my risk tolerance?
I think the starting point has got to be, what time frame are you using? Investors who are looking to achieve outcomes a long way in the future can afford to take more risks than those that need a short-term outcome. And then there just has to be an understanding of what is the maximum amount that you are prepared to lose, because nothing is guaranteed. So limit the size of individual positions to control their ability to have an impact on the overall portfolio, and always think about structuring the portfolio to match the timescale for which you're investing.
Thank you, Steve. I actually got a good question that follows up from that point. It's, although we are encouraged to think longer term, how do you choose shorter or medium range stocks? I think I may know the answer here, which is we don't.
You saw me coming. Yeah, we are, as I said, we're fundamental investors. We simply do not believe that it is possible to predict where the stock market goes in the shorter term. It is, after all, driven by sentiment on a daily basis, sentiment and news flow. So we just don't see the stock market as a place for short-term investing. Even on the medium term, we're much happier thinking in multiple years than anything less than that.
Thank you, Steve. Then what about this question that we've got about geopolitical activities? How important is it to hedge our portfolio against geopolitical volatility seen as evident in the Red Sea and with upcoming elections of new administrators?
Great question. And The answer is that some risks are easier to hedge than others. So, for instance, you could say that events in the Middle East have the potential to send energy prices sharply higher. So you might want to think about making sure that you don't have too much exposure to companies who are very dependent on lots of energy inputs in their cost base. You might also want to think about making sure that you've got some exposure to companies that actually produce energy, because if things do flare up and energy prices do go sharply higher, then at least you'll have a degree of hedging in place. But for some risks, it's very hard to identify an effective hedge. And that is the thing about stock market investing. You do have to take risk.
Thank you, Steve. We've actually got a question about your select funds. So this question here is investing in the income fund safer than in the growth and income? But before you answer that, just a quick reminder to everyone that holding 1, 2, or 3 of the select funds doesn't make up a diversified investment portfolio on its own.
Is the income fund safer than the growth fund?
Than the growth and income fund.
We have an income fund and we have 2 growth funds.
Yeah.
Is the income fund safer? I would not consider it to be notably safer. It does generate more of its return from dividends, but those are variable and they're not guaranteed. So I don't think it is possible to say that it is definitively safer than the others.
All right, thank you, Steve. We have another interesting question here. We can't mention specific stocks, but is there increased risk to stocks where a takeover bid has been placed on the company?
Okay, so if a bid has been made, then normally the price will have risen to reflect the expected level of the bid. So from this point on, if an investor is considering buying that stock, then the question is the stock price below the proposed bid level, in which case there may be some upside, but where's the stock price going to go to if the bid falls apart? And often the answer there is quite a long way down. So you can end up with a situation where the downside is that big and the upside is that big, and it all comes down to the probabilities, which one is more likely to happen. And judging that determines whether there is an investment case to be made. But generally, I would say that by the time a bid has been made, the party's over.
All right, thank you, Steve. We've got another question here about the HL Select funds. A reminder, we're not going to be able to go into specific stocks here, but the question that we've received is, you currently have around 10% of the UK Select Fund in 4 US companies. Do you see this weighting increasing further over time? And would you consider adding other overseas holdings outside of the US market?
Okay, so this is referring to the HL Select UK Growth Shares Fund. It is a UK fund, but the rules allow us to invest up to 20% of the fund into non-UK shares. And because it's a growth fund, we've chosen to bring in some US technology names like Visa, which is basically financial technology, and Adobe and Autodesk and Microsoft into this fund, because in the UK market, the technology sector is really quite small. And for a growth-oriented fund, we think it's appropriate to have a higher exposure to technology than you can easily get from the limited number of UK technology names. Will it go any higher? It can't go above that 20% level. We're pretty happy with the amount of tech exposure we've got in this fund at the moment. So I'm not really expecting a significant change in that level, either up or down.
Thank you, Steve. Earlier, we spoke about investment objectives and filtering down from stocks. So we've got a good question here that's diving a little bit more into that. What I have here from one of our viewers is, when looking at markets to invest into, should I go for the largest countries in the world?
Are we talking geographic or market value, I suppose? Yeah, I think the US market is hugely influential in global equities. It accounts for approaching 2/3 of global market value. Now, some people argue that's because it has the most dynamic economy. Others will argue that that's a sign that the market valuation is extended. My team, because we are very, very selective, we can always find exciting growth companies to back in the USA. And because there is such a large and growth-oriented economy in the States, we think it makes sense for our global fund to be investing significantly in the USA. Other larger nations don't necessarily have the same growth prospects. China, huge economy these days, but it carries risks unique to itself because it's a very unusual political situation. So every nation needs to be judged on its own merits, but certainly see a strong case for investing in the US for any global investor.
Perfect. And here's another interesting question from an investor, but this is, how do you know when to take profit on a stock?
Oh, now that is probably the most challenging thing for any investor, professional or private. The risk is that you sell something and you actually throw out a really good long-term company. So we tend to be quite cautious in the way we approach selling. If we think a business is a great company, then we will need to see its price having risen to levels where we just can't see a superior return going forwards before we think about selling. Really, more often our sales are driven because we've seen something fundamental changing. Maybe it's a reduction in the expected growth rate of an industry. Maybe it's a sign that competitors are starting to challenge the company's competitive moat more effectively. Choosing when to sell, it is very difficult, and you have to fight a lot of personal biases, because lots of people instinctively, just the act of purchasing becomes almost a commitment to a stock, and you have to fight that bias and be objective at all times.
Thank you very much, Steve. We've got a question here about news sources. I think you mentioned it earlier. You didn't get to go into the detail. What news sources do you like the most for your investment information and your industry trends?
Okay, so we are professional investors. We have access to a lot of sources that are very expensive, that are not realistically within reach for private investors, and that is a huge advantage for us. But there is an awful lot of stuff out there that everyone has access to. I mentioned companies' investor relations websites earlier, and those vary from company to company, but they often have a real treasure trove of information, both reports and accounts, but also strategy presentations, explanations of how their industries operate. You can learn an awful lot there. Using those investor relations contacts to put questions directly, again, is another source. The internet is full of information. There are lots of great investing blogs out there. I'm afraid I can't tip anyone in particular, not least because somebody who's been given sound advice yesterday might talk nonsense tomorrow. But there is a lot out there. You have to be your own judge. You always have to be very skeptical when you're looking at anything on the internet, of course. If it's not from an official source, beware, because we all know that the internet is a strange place.
Perfect. Thank you, Steve. And looking at the time, it looks like we only have the opportunity to go for one more question. What I have here is, when you meet the management of companies, what positive characteristics do you look for that indicate good management?
So we really want to see management talking about how they are positioning their company for the future. We want to see them showing real objectivity. Every business from time to time has to make tough decisions. We want to walk away knowing that the people who are stewarding our investment have got the mettle to take those decisions when they become necessary. It's looking for that balance of objectivity, forward thinking, and resolve that is key for us.
Right, perfect. Thank you, Steve. And with that, our webinar comes to our end today. So thank you again to everyone that joined us. I hope you found this session helpful as you continue to learn and develop on your investment journeys. Remember, if you're interested in learning more about Steve, learning more about his team, you can find this information on our website. I hope to have you again with us in the future. Have a lovely afternoon, everyone. And thank you once again for joining. Thanks again, Steve.
Thank you, TJ, and thank you everyone for watching.